David Gandler is the co-founder and chief executive officer at the company. David, great to have you guys back on the show here. So a big report, and the analysts are liking what they see. The first thing that jumps out to me is more than 50% in terms of growth for paid subscribers on an annual basis. Where are they coming from? Are they cutting the cord from cable, or are they adding you guys on top of what they already have?
No, this is definitely a cable cord cutter service. I think we, last time we spoke, we did mention the fact that there was pent-up demand coming into the start of the NFL season for sports, and we saw that in the third quarter.
So this is specifically about football, you think?
Well, just generally speaking, I mean, we're a sports first pay TV replacement service. So, generally you see sports fans that are interested in cutting the cord and getting access to their favorite teams and games with the best user experience that they can get. And that's where we come in.
How much do you think you will see either kind of ties to the sports season? Do you expect variability in terms of subscriber churn based on what seasons or what sports they want to watch?
Yeah, that's a good question. Look, we were able to increase our sub base by about 30%. So, clearly there's going to be some elevated churn just given the size of the cohort. But the fact that college football season started a little bit later, at the start of October, that gives us a good sense that we're in a good place with respect to churn and continued sub growth. In fact, we're starting to see some really solid trends, and we have raised our guidance higher.
Now, the guidance largely tied to that advertising, right? Walk me through the top line and what makes it to the bottom. Is this from advertising? Is it specifically from the subscriptions as well? What's that breakdown in terms of revenue?
Yeah, of course. Well, it's a combination of the two. FuBo is a dual revenue stream business. We charge subscription fees as well as generate revenue off of the time that people spend on the platform watching. So, we've revised our guidance for sub count between 500 and 510,000, and we've also, raised our guidance for total revenue, which obviously includes advertising. And advertising in the third quarter was about 12% of total revenue, and we're starting to see the advertising side really start to kick in, given the strength of the tailwinds coming from the shift of TV ad dollars to connected devices. One
of the figures I see is that monthly active users watched 121 hours per month on average in the quarter. I'm not like a TV pro, obviously, but that seems like a pretty big number, David. Are people just leaving it on?
Yeah. Listen, no, look, it's a huge number. I mean, remember, this is a pay TV replacement service. So if you look at Nielsen data, the average household watches about 300 hours per month. That's a Nielsen number. So we've got some room to go. We have over 110 channels and really have great content for every member of the family.
So you're getting subscriber gains. That's obviously helping. In terms of the dollar amount that you're getting per subscribers, that average revenue per user, the ARPU, a really important metric for a lot of investors looking at subscriber-based companies, was also up on an annual basis. How do you drive that number higher going forward? Do you plan any changes to pricing dynamics?
Yeah, well, we recently raised pricing by about $5 at the start of the quarter with the addition of Disney and ESPN. The other key drivers were obviously the improvement in advertising sales, and those two are really the key. And then the third piece is the quality of the merchandising that we've been able to put together over the course of the last couple months. We sold about 800,000 attachments in third quarter. That's well over the 235,000 attachments we sold in the prior year. So the team is just better leveraging its data and using that data to better merchandise both our services that include things like cloud DVR as well as our content attachments, which include Red Zone, for instance.
Do you have the capacity to keep servicing and keeping the quality of up as you get more subscribers on? Do you need to hire more? Do you have the tech? Should we expect spending to show up and CapEx to show up in the company over the coming quarters?
Yeah, look, a great question. Look, at the end of the day, this is a cloud-born platform, so it's automated and extremely scalable. This is a very CapEx light company, given the fact that we're so software centric, but we certainly will continue to invest in the technology platform. We'll continue to invest in our ad technology as well, attempting to productize a lot of the data that we are collecting. As I mentioned, I think on our last call, we collect about 21 billion data points. And so we're getting to a point where, as we start to sort of productize that data, we should start to see CPMs increase at a very favorable rate.
Okay. David, great to have you back on the show. Congrats on the quarter. Looking forward to continuing the discussion. Thanks a lot.
Thank you.
David Gandler is the co-founder and CEO at FuboTV.